There is a huge shift happening in our economy right now. And it's not just some abstract thing with numbers on a screen. No, this is a new reality that's changing pretty much everything, from our personal finances all the way up to the global markets. So in this explainer, we're going to break down what's really going on.
Have you ever had this feeling? You see the headlines, and they look pretty good, but underneath it all, it just feels like we're living in two totally different economies. So what's actually happening? Well, the answer might just surprise you.
You can really sum up the answer with just a single letter, K. We are in what economists are calling a K-shaped recovery. And what that means is the economy isn't just going up or down. Nope. It's actually splitting in two. One branch is shooting up, while the other is heading straight down. It's truly a tale of two economies.
So let's start with the corporations. That top arm of the K, that's the story of the best versus the rest. The profit margins for the Magnificent Seven, the big tech giants, they are absolutely soaring. But for the other 493 companies in the S&P 500, those margins are actually trending down. And it's the exact same story when you look at households. This is the bottom arm of the K. Wage growth for higher income families, it's holding steady, right around 4%. But for lower income households, it's dropping like a rock, all the way down to just 1.4%. The gap is real, and it is getting wider.
So this is it. This is the K-shaped economy we're talking about. All the economic strength, all the growth is getting concentrated. It's flowing to a very select group of huge corporations, especially the ones deep into AI, and to higher income consumers, while a whole lot of other people are getting left behind.
So what in the world is driving this massive split? Well, it pretty much boils down to one single technology that is having an absolutely enormous impact on everything: artificial intelligence.
To really get the scale of this, just look at the numbers. Between 2025 and 2029, the hyperscalers, that's the tech giants building out all the AI infrastructure, they are projected to spend a cumulative $2.7 trillion. And this isn't some slow burn. We're talking about a spending spree that's happening at a blistering pace. Their capital expenditure has already grown 7.2 times since just 2023. This is an absolutely unprecedented investment cycle, especially for the private sector. And they're not just digging into their own pockets. In just the last 3 months of 2025 alone, we're talking giants like Oracle, Meta, Google, Amazon. They issued $90 billion in new debt, all of it to fuel this AI expansion.
I mean, to put this into perspective, you have to think big. Apollo analysts actually compare it to something like the Eisenhower Interstate Highway System. Yeah, that's right. We're talking about a private sector infrastructure project on the scale of a massive government program.
And all this borrowing, this colossal need for cash, well, it's completely rewriting the rules of the game in the credit markets. We've entered a whole new kind of buyer's market.
For years and years, it was a seller's market, right? You had all these investors fighting over a pretty limited supply of corporate bonds. But now, that's all flipped. We're in an era of selection. There's a flood of this new AI-related debt, and that means the companies, the borrowers, they now have to compete to get investors' money.
And just look at the supply coming our way. For 2026, we're looking at an estimated $2.25 trillion in high-quality corporate debt. That is a new all-time high, no question. This huge supply is exactly why it's a true buyer's market now for investors.
Okay, but here's where it gets tricky. This new market, it creates a really dangerous illusion. Investors, people who think they're playing it safe, diversifying, they might actually be making one single massive bet without even realizing it.
Just look at how these AI giants are projected to take over the investment-grade index. By 2030, you've got Amazon jumping from 15th place to number 3. And Google, they're expected to leap from way down at 67th all the way to 8th. What this means is the whole market is becoming dominated by just a handful of companies all chasing the exact same thing.
And this is the kicker. As the Apollo report puts it, what looks like diversified exposure may in fact be one concentrated macro trade, long AI. Think about it. Your bond fund, your real estate investments in data centers, your tech stocks, suddenly they're all hitched to the wagon of a single technology.
Okay, so if you're a savvy investor, where do you go? How do you find shelter from this AI storm? Well, reports are pointing to a few interesting places. Things like European private credit, because it's less tangled up in this hyperscaler arms race. Alternative assets, like infrastructure. And then there's this one really fascinating area, sports financing.
Sports? Yeah, sports. Why?
Because think about what the core product is. It's elite human performance. It's that scarce, emotionally powerful experience that AI just can't copy. You can't automate it, you can't replace it. It's one of the very few things that's truly insulated from all this technological disruption.
So, this economic earthquake isn't just shaking up the markets. It's also about who gets to hold the power, who gets to write the rules in this brand new world.
And that brings us to this idea called plutocracy 2025. Basically, it's a world where having enormous personal wealth isn't something you hide anymore. Instead, it's flaunted as the ultimate qualification, as proof that you're competent enough for public office.
And one article gives us a pretty specific case study. Donald Trump's pick to lead the Federal Reserve, Kevin Warsh. If he gets confirmed, we'd be talking about one of the wealthiest Fed leaders in American history.
But here's the thing. The issue that's being raised isn't just about the wealth itself. It's about how murky it all is. His financial disclosures list over $100 million in funds where you can't actually see the underlying assets. It's a black box. And it seems like a lot of it is tied up in things like illiquid crypto and AI ventures. You can see the problem, right? This raises serious concerns about potential conflicts of interest. He could end up regulating the very sectors that made him his fortune.
And that really brings us back to the biggest question of all. As our economy is literally being reshaped by AI, splitting into this K-shape, who gets to write the rules for the rest of us? And more importantly, how do we make sure those rules work for everyone, and not just for the people at the very, very top of the K?